Just a few days ago, Singapore's three local banks, DBS, OCBC, and UOB, released their latest earnings. DBS delivered a record 3.44 billion Singapore dollars in pre-tax profit, despite higher taxes. OCBC saw a slight dip in profits, but still managed to beat analyst expectations and maintain strong capital buffers. And UOB? They're doubling down on ASEAN, scaling up digital banking and wealth management, and the results are starting to show. But here's what most investors overlook. This isn't just about one quarter. It's about long-term strategy, dividends, share buybacks, and how you can build wealth with these banks for decades to come. So stick around till the end. We'll break down the strategic playbook of each bank, their dividend plans and capital returns, and how to invest, whether through CDP or fractional shares. And if you find this helpful, smash that like button and subscribe to Wealth for You, so more investors like you can get informed and invest confidently. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Please do your own due diligence or speak to a licensed advisor before making any investment decisions. Chapter 1. Q1 2025 Financial Performance. Let's begin with the recent financial results. DBS reported a net profit of 2.9 billion Singapore dollars, a 2% decrease from the previous year, primarily due to higher tax expenses from the global minimum tax. However, profit before tax reached a record 3.44 billion, with total income rising 6% to 5.91 billion. Return on equity stood at 17.3%, and the bank declared a dividend of 75 cents per share, comprising 60 cents ordinary and 15 cents capital return. OCBC achieved a net profit of 1.88 billion Singapore dollars, down 5% year-on-year, mainly due to lower net interest income. Despite this, the results slightly exceeded analysts' expectations. Return on equity was 13%, and the net interest margin declined to 2.04% from 2.07% a year earlier. UOB posted a stable net profit of 1.49 billion Singapore dollars, unchanged from the previous year but slightly below market expectations. The bank experienced a 20% increase in net fee income, driven by robust loan-related and wealth management activities. However, non-interest income declined due to reduced trading and investment returns. Chapter 2. Strategic Directions. Let's begin with DBS, Southeast Asia's largest bank by assets. DBS continues to be the digital leader among the three. It was one of the first to embrace AI and cloud technology in banking, and its digital customer base now accounts for a significant portion of revenue. Their former CEO Piyush Gupta has stated that the bank aims to become the best digital bank in the world, and they're backing that up with regional expansion too. DBS is growing in India, China, Taiwan, and Indonesia, leveraging bolt-on acquisitions and partnerships to scale quickly in these emerging markets. The bank also intends to future-proof its business by expanding into non-traditional areas like digital exchanges and sustainability financing. Next, OCBC. Their strategy can be summed up in two words: integration and balance. OCBC is executing a one-group strategy, streamlining their consumer, wealth, and insurance arms across ASEAN and Greater China. They're heavily leveraging their 100% ownership of Great Eastern and Bank of Singapore to offer integrated financial services from insurance to private banking. OCBC's strength lies in its stability and prudent management. Unlike DBS and UOB, it is more conservative in risk-taking, and this shows in its balance sheet quality. They're focusing on strengthening wealth management capabilities, particularly in North Asia and ASEAN, which are seen as growth hubs. Then we have UOB, often seen as the most ASEAN-focused of the three. UOB is betting big on the region's rising middle class. They recently completed the acquisition of Citigroup's consumer banking business in Malaysia, Thailand, Indonesia, and Vietnam, giving them immediate access to millions of new retail customers. They're also developing a unified digital banking experience via UOB TMRW to engage customers across all 5 ASEAN markets. UOB's leadership is placing more emphasis on growing fee income from wealth management and cards, rather than relying solely on interest income. Their aim? To be the most trusted bank for ASEAN's consumers and SMEs. So in summary, DBS is aggressively expanding digitally and regionally with a bold, tech-forward mindset. OCBC is integrating wealth and insurance across borders, aiming for stability and comprehensive service. UOB is doubling down on ASEAN and consumer growth through regional acquisition and tech upgrades. While they're all exposed to similar macroeconomic factors, these different strategies give investors options based on their own risk preferences and beliefs about the future of Asia's economy. Chapter 3. Long-term investment perspective. Short-term market noise comes and goes. Interest rates shift, earnings fluctuate, and headlines stir fear. But when you zoom out, one thing becomes clear. Singapore's big 3 banks have stood the test of time. Over the years, DBS, OCBC, and UOB have consistently rewarded shareholders with growing dividends, strong capital positions, and stable long-term returns, even through global crises. By adopting a long-term mindset, you're not just betting on the next quarter. You're investing in decades of disciplined management, a resilient economy, and the future of ASEAN's financial growth. Whether you're receiving quarterly payouts or watching your shares steadily climb in value, the real power lies in staying invested, letting time, dividends, and compounding do the heavy lifting. Chapter 4. Can you buy fractional shares of DBS, OCBC, or UOB in Singapore? If you're wondering whether you can own fractional shares of Singapore's big 3 banks, DBS, OCBC, and UOB, the short answer is not directly through the Central Depository CDP system. A CDP, or Central Depository Account, is where shares of SGX-listed companies are held in your name. When you buy stocks through CDP, you're a registered shareholder, which means you have voting rights at AGMs, you receive dividends directly, and you own the shares outright, no middleman. But here's the catch. You can only buy whole shares, usually in lots of 100. For example, 100 shares of OCBC might cost over 1,600 Singapore dollars upfront, a high entry point for new investors. While CDP doesn't support fractional shares, some brokerages let you buy fractions of Singapore bank stocks using a custodian model, where the platform holds the shares on your behalf. You still receive dividends proportional to what you own. Popular platforms that support this include Syfe and Intereactive Brokers. These let you invest with smaller amounts, receive dividends into your brokerage account, and build a position over time without needing 1,000 plus Singapore dollars upfront. However, take note, you don't get direct shareholder rights, i.e., no AGM voting, shares are not held in your CDP, and fees and withdrawal rules may vary by platform. If you want full ownership and your name on the shareholder registry, go with CDP, but you'll need to buy whole shares. If you're just starting out or want to invest bit by bit, fractional share platforms offer a lower cost entry and still pay out dividends. Either way, long-term investing in strong dividend-paying banks like DBS, OCBC, and UOB can be a powerful way to grow your wealth. Closing thoughts. DBS, OCBC, and UOB continue to show remarkable resilience and adaptability, even in uncertain times. Their strong fundamentals, strategic clarity, and consistent dividends make them powerful anchors in any long-term portfolio. If you're serious about building lasting wealth, Understanding each bank's direction and staying invested for the long haul could be one of your smartest moves. If you found this video helpful, please give it a thumbs up, subscribe to Wealth for You, and hit that notification bell so you never miss an update that could guide your next smart investment decision.